Most real estate investors will unknowingly pay thousands of extra dollars to the IRS this year, not because they don't make enough money, but because they didn't take the right steps before December 31st. And what hurts the most, these are the steps that are very, very simple, legal, and 100% available to every investor. They just get missed because no one explains them to them clearly and they don't take action. Today, I'm walking you through the 7 year-end tax moves every investor must make, whether you own a short-term rental, a long-term rental, or you're just getting started. Some of these moves can save you $10,000, $20,000, $50,000, or more, depending on your real estate portfolio. So stick around until the end because I'm giving you the exact year-end real estate tax checklist my paying clients use, and a link to download a free bonus depreciation guide so you can take full advantage of the tax code. Move number 1, if your property isn't in service before December 31st, you're choosing to pay more in taxes. In service doesn't mean rented. It really depends on what kind of property that you have. For a long-term rental, in service means ready, available, staged, listed, and utilities on. For a short-term rental, in service means actually rented, generally 3 times minimum or 14 days. Putting your property in service before year-end unlocks depreciation, and if it's a short-term rental, it unlocks bonus depreciation that can eliminate a massive amount of taxes on your W-2 or business income. I've seen clients miss out on 30, 60, and even 120K in write-offs because they waited until January. Don't do that. If you want my free bonus depreciation guide, the one that explains exactly how this works in plain English, go click the link below in the description. Move number 2 is prepay and accelerate expenses. The IRS lets you pull certain expenses into this year, even if they technically cover the next year. You're going to spend that money anyway. All you're doing is deciding which year you get that deduction. This includes things like insurance, property taxes, supplies, repairs and maintenance, accounting, legal and consulting fees, utilities, cleaning, or turnover services. This is one of the biggest year-end tax wins, and almost nobody uses it. Comment year-end, and I'll send you my full list of expenses you can accelerate before December 31st. The third move is to clean up your books. You need to do your bookkeeping. I know it's not fun. I know you'd rather do anything else, but messy books cost real estate investors more money than anything else I see. Missing receipts equals lost deductions. Commingled accounts equal lost deductions. No mileage log, lost deduction. Sloppy categorization equals incorrect depreciation. You can't expect your CPA to save you what you don't show. If your books are a mess, DM me the word books. My team can get you cleaned up before tax season. Moving to number 4 is for short-term rental owners. You want to confirm your material participation hours. The short-term rental loophole is one of the most powerful tools in the entire tax code, but it dies the moment you stop tracking your hours. You need at least 100 hours and more than anyone else, or 500 hours total, or you need to be doing substantially all the work yourself. If you're messaging guests, managing cleaners, doing repairs, setting up your listing, coordinating turnovers, these hours count. But if you don't document them, then it's as if they don't exist. Comment STR, and I'll send you my STR material participation checklist. The 5th move is to decide whether a cost segregation study belongs in this year or the next year. Cost seg plus bonus depreciation is a huge tax tool, but only when it's used at the right time. Sometimes it's better this year. Sometimes it's better next year. Sometimes it shouldn't be done at all. Here's the rule: if you're not materially participating, or if the losses won't benefit you this year, or if you're expecting a higher income next year, the timing matters more than the study itself. And if you want a full breakdown, download my bonus depreciation guide using the link in the description. Move number 6, review your entity structure before the year end. This is where investors get hurt, not because they bought the wrong property, but because they structured it wrong. Ask yourself, do my rentals belong in LLCs? Do I need a holding company? Am I accidentally mixing flips and rentals? Am I exposing myself to unnecessary liability? Do I have the right insurance? Do I have the right insurance coverage? Is my structure aligned with my tax goals for 2025 and 2026? Estate planning matters, asset protection matters, and the tax planning ties it all together. If you want me to map out your entire structure on a call, go to bristertaxlaw.com and book a comprehensive consult. Now the last move number 7, and honestly, this is the difference maker. Have a year-end tax planning and strategy meeting. Once January hits, 99% of your planning options disappear. A strategy meeting is where you project your tax bill, decide which expenses to accelerate, decide whether to do a cost seg now or later, review STR or rep hours, lock in your entity strategy, confirm your depreciation, and take every deduction that you've earned this year. And this is how you avoid April surprises. If you want me and my team to walk you through this, go to bristertaxlaw.com, secure your end-of-year tax planning session. So December 31st is not just a date, it's a deadline that determines what tax benefits you get to keep and which ones you lose forever. I've seen too many investors realize in January what they should have done in December or earlier in that year. Don't be one of them. Download your free bonus depreciation guide, get the link below, and don't forget to schedule a discovery call if you're serious about your real estate tax savings. And don't forget, please like and subscribe. This helps get this out to other investors like yourself. If you know anyone, please share that with them. This is your window. Take action now, protect your money, and step into 2026 with clarity and confidence. We'll see you next episode.